Hey, welcome back to the Realty Check. My name is Nick Melillo and I'm your host. The Realty Check is a show where we kind of cut through the BS in real estate, tell it like it is. Today is all about mortgage rates. It's going to be kind of a shorter episode than, what I've been doing for the last few, but I want to answer a couple of questions that I generally get from potential clients on the sell side, from the buy side, friends, family, neighbors, anybody who learns that I'm in real estate, something mortgage rates winds up coming up in the conversation. So kind of wanted to kind of go over those types of things and just make a video about that. So, some of the questions like, are we ever going to get back to 2%, 3% like we saw, in 2020? Are rates going to be lower this year? Or, are they going to go up again? Why maybe today's rates feel so high because they were low pretty recently. So we're going to go over a couple of those things today and just answer some of your questions about mortgage rates. And if you do have any questions about them that I don't cover today, put them in the comments because I'd love to do probably an update episode later on, maybe this year, to see, how mortgage rates have changed. So I guess that's it. We're going to get into it right now. Thank you so much for joining the Realty Check. Let's get into it. Okay, so let's start with where rates actually are right now. So today's March 3rd, 2026. If you're looking back on this after a few years, obviously numbers are probably different. But right now, today, you're looking right around 5.8% on average on a 30-year fixed rate mortgage. Could be a little bit more, could be a little bit less if you buy some points. But right around 5.8% is kind of where we're looking at average. And then for a 15-year mortgage, you're a little bit better. You're losing about 0.5%. You're at 5.3% on a 15-year mortgage. Refinance rates are slightly higher depending on the lender and the loan type. That all kind of goes into, again, your credit score, but also the property itself and its appraisal and all of that. So let's, focus on just general numbers here. I obviously don't know what your interest rate is or what your interest rate is going to be because there's no way of knowing that. There's a lot of elements that go into it. But generally speaking, on average, the 30-year fixed rate mortgage is sitting right around 5.8 to 5.9-ish, maybe even 6%. That's on average. Now, that's obviously nowhere near as low as what we were seeing back 2020, 2021. I mean, I've talked with people who are like, yeah, I bought my house in 2019 or 2020, and we've got a 2.6% interest rate. And I'm like, yeah, there's no way I can't help you with that, get a better rate, but that's not always, the name of the game. So, back 2020, 2021, 3% was like a thing. It was pretty close to average 3% interest rate back then. And, it makes sense because we were trying to spur things in the economy because of COVID and whatever else. And there was this housing boom. People were staying in their homes. So the home had a different kind of, value to it. And so, there was obviously a lot that mixed into it, but generally speaking, interest rates were pretty low back then. And so if you bought a property in 2020, 2021, you most likely got a really, really, really great interest rate. Or if you had owned your property for a while and it was time to refinance, like that was the perfect time to refinance because you would have gotten a lower interest rate for a higher valued property. So, that was kind of a win. Obviously now we're talking 5 to 6 years ago. That's not the case anymore, right? But what you have to understand is that where we're at now, 5.8, 6%, 6.1%, is still like a multi-year low compared to where we've been, generally speaking in the past. Last year rates were 6.5 to 7%, 6.9%, 7%, 7.2%. And now, you're getting below 6%. And that's just in 1 year's difference. So we haven't seen, I think I saw this headline. I forget exactly what it was. Maybe it was like CBS or something, but we haven't seen interest rates below 6% for at least 3 years. Okay. But generally speaking, like overall, I think average for the last 30 years is around 7%. So if we're at 5.8%, we're actually, speaking over the last 30, 40 years, doing really well. You got to understand, in the 80s, the mortgage rates fluctuate so much. In the 1980s, I forget exactly what year, but I was looking at some numbers. There were people who were buying houses with like 14, 15, 17, 18% interest rates. 18% on a house, on a mortgage. And we've got people complaining about 5.5%, 6%, because 5 years ago, people were paying 3%. But, in 1988, maybe, you were getting 17%, right? So it all kind of averages out to around 7% over the last 30 years. The bottom line, though, is that right now rates still feel high because people remember, we have a good memory of the last 5 years. We remember 5 years ago when rates were 2.5% to 3%. But in the context of national historical averages, 5.8% or 6% or 6.2% is actually decent. It's pretty good. It's just you can't say that's great because 5 years ago you could have gotten 3%. But if it was 15 years ago when you could have gotten 3%, then you might feel a different kind of way about it. Or if 5 years ago it was 10%, 6% would be awesome, right? So it's all relative. It's all contextual. So that's where we're at right now, is right around 6%. And that's why it feels a little bit high, because it's doubled, it feels like, in the last 5 years, 6 years. But let's move on to one of the questions I get a lot, which is, could rates ever hit 3% again? Are we ever going to see a 3% interest rate or a 2% interest rate? Is that possible? The answer is yes, but probably not soon. And I could be wrong. It could happen quickly, soon. But generally speaking, you're not going to drop 3% as quickly as we rose by 3%. So experts, I was reading something from Delmarva that said experts and analysts agree a return to 3%-ish long-term fixed rates isn't realistic in the near future. That's what Forever Delmarva says. Now, how true is it? It's hard to say, because the truth of it is that tomorrow, the Fed chair could come out and say, hey, we're looking at the numbers and we decided that we're going to lower interest rates by 3%. It just could happen. We have no controlling, over that. We are at the whim of the Federal Reserve, which is a whole other thing that I don't really want to get into right now. But the Fed funds rate isn't expected to drop dramatically. It also doesn't rise very dramatically either. It kind of goes by like a point or a half a point or, a quarter of a point one direction. But what's nice is that inflation has kind of cooled off in the last year or so. So, obviously we're not at deflation, but we're not at 7% inflation. We're at something lower, like I think it was 2.5 or 3% interest or inflation. So you've got Fed is not thinking about expecting to drop interest rates very dramatically. Inflation is doing okay. And bond yields, which mortgage rates kind of follow and track bond yields, aren't really crushing it right now. So generally speaking, you're not going to get your mortgage rate crushing it either. So if you're holding out for 3%, you're basically betting on wildly unlikely scenario. But if you're holding out for maybe 5%, you probably have a better shot because they're kind of moving in that direction. But even so, 5% is a pretty decent jump from 5.8%, because you're talking about billions and billions and billions of dollars overall if you're talking about interest rate on all mortgages, right? So hundreds of billions probably. So, the question is, will we ever see 2.5%, 3% again? The answer is yes. Yeah. Pretty confidently, I can say we will eventually see those numbers again. But when that is really hard to define, to the point where it's something I say all the time is don't buy for the interest rate, buy for the price and the monthly payment that you can afford now, because prices are going to go up. Interest rate might, but interest rate might drop. The prices are not going to drop. Prices are going to continue to go up year over year. So purchase for the price you can afford, for the monthly payment you can afford now, with the interest rate that you're going to get on a fixed rate interest rate. Because eventually, if and when interest rates come back down, that's when you can go ahead and refinance. You marry the price, you date the rate. I've said it many times, but I'm going to keep saying it because it's true. Marry the price, date the rate. The rate's going to change. The price is not. You're locked in at whatever price you chose to purchase the house at. You are not locked into an interest rate in the way of saying a fixed interest rate isn't going to change on you. It's never going to go up on you. You can decide to refinance, and you do that, obviously you want to do that when rates are better, and you have a good amount of equity in your property, because then you can cash out and then you're getting a lower payment. Or not necessarily a lower payment, a lower interest rate is what I should say. So that's that. So now let's move on. I had this conversation with someone yesterday. They asked, why are rates going down? Why did it drop? Why are we seeing the lowest rate in several years? And there's a couple of things. It's not really a ton. It just moves, but a couple of things. The federal housing policy. So a huge mortgage-backed securities purchase program injected liquidity into the market, which helped push lower rates. So I'm pulling up the Economic Times. You can read along with me. The title is $200 billion Housing Move Triggers Immediate Mortgage Relief. Who sees lower payments? Here's new mortgage rate outlook 2026. That's the title, the headline, by Piyush Shukla of Economic Times. Last updated February 27th. And I am using an ad blocker, so it doesn't want me to pull up this article. But suffice it to say that individual kind of tells us that a massive mortgage-backed securities purchase program injected liquidity into the market, which helped lower rates because the market's a little bit more liquid. There's a little bit more cash flowing around for everybody. Money becomes cheaper. Now, the other side of things is that Treasury yields fell, and lenders priced rate offers lower because of bond activity. Like I said, mortgage rates follow the bond yield. So because the yields fell, lenders priced rates a little lower. And this is from ColoradoBiz.com. Colorado Biz, U.S. mortgage rates dip below 6% as supply lags. That's as of February 26th. So they're pulling from Reuters, it looks like. But even so this very first sentence, the average rate on the popular U.S. 30-year fixed-rate mortgage fell below 6% this week. That was last week. Right? Last week? Yeah, last week. For the first time in 3.5 years. Now, this article argues that economists say the improvement is likely temporary and insufficient to boost housing demand unless supply increases. Now, here's the thing about supply increasing, is that if interest rates come down, money is cheaper, right, for the buyer, which means more buyers come to market. There's more buyers and only X amount of houses, right? There's less demand, there's less supply and more demand. When demand increases and supply stays the same, what happens? Price goes up. When you have a higher supply and a lower demand, price comes down to match the demand. So when interest rates, here's what happens. When interest rates come down and more buyers flood the market, if more sellers don't also equally come into market and put their houses on, then prices are going to naturally go up because there's more people competing for those properties. Right. So people ask why the rates dropped. It's pretty simple. Boring. It's boring. It's simple conceptually. It's boring and complicated in truth. But the truth is market dynamics, and $200 billion came into the market. That's pretty much that. Sustainability of these rate drops is pretty up in the air. It's a question mark. Is it sustainable? Are we going to have less than 6% for a while? I don't know. The answer is nobody knows. Is it going to stay where it is? Is it going to drop? Is it going to go up again? Nobody knows. And also, yes. Yes, it's going to go down. Yes, it's going to go up. Yes. That's your answer. Yes, it will go down. I have no idea when. And yes, it will go up. I have no idea when. Moving on. Let's talk about refinancing. So what does this all mean? What does interest rates dropping below 6% mean for you? Well, if you are a homeowner, right, and you have no intention of selling your house, you're happy where you're at, you're comfortable with your mortgage payment, but, hey, lower interest rate, maybe we could get a better number for our mortgage payment. Maybe we could cash out, take a little bit of vacation or something, right? It's possible. So if you bought a home at 7% or higher, you might be able to shave your rate down and save on your monthly payment. But most real estates aren't going to tell you this. You have to look at your closing costs, how long you plan to stay in the house, and whether you're going to break even. It's not always a slam dunk to refinance. Obviously, refinancing is a key tool in a lot of people's financial decision making, but it's not always the home run you think it is. If you had like a 9% interest rate and you refinanced at 5.8, then yeah, you're probably doing great. But generally speaking, what you want to do is you want to talk to a lender, not a real estate agent, but a lender about refinancing. Hey, here's the balance on my mortgage. Here's my, credit score. Here's my blah, blah, blah. Let's go ahead and I want to look at refinancing. I want to see what my options are. Refinance it at its current appraisal for the lower interest rate that we've got and see what you can do. You probably can save some money if you had above 7% going into a refi. So that's if you're not planning on selling or buying. If you're planning to buy, lower rates increases buyer power. So now whatever you could afford, right, has increased in value because money has become cheaper. So it costs you less, it costs the lender less to lend you that money, it costs you less to have that money lent. So therefore you have more money to work with. But like I was saying before, that doesn't equate to supply being fixed at all. So if there are, let's say you're shopping in one county, right? And there's 250 houses on the market in that county right now. Okay. Interest rates go down. That means you and more buyers like you can afford more house, right? But that doesn't mean that there's more houses coming out on the market. So now, instead of there being the 1,000 buyers on the market for those 250 houses, now there's 1,500 buyers on the market for those 250 houses. So when the low inventory stays and more buyers flood the market because money becomes more expensive, well, now it's more likely money becomes cheaper. Well, now you're not competing against 1,000 people, you're competing against 1,500 other people to buy that same house. So prices are going to go up. And the price might not go up. You might not log into Zillow one day and see a house at $250,000. And then the next day, because interest rates went down, it went up to $260,000. That's not what I mean. I mean that you're going to make an offer at $250,000 and the next guy's going to have the same interest rate offer as you, but have a little bit more to put down maybe, for instance, or whatever, or money became cheaper for him. So now he's willing to go to 260 to beat you to get into that house. See what I'm saying? So that's on the buyer side, what lower interest rate. Now, also, what a lower interest rate means is that you're going to have a lower monthly payment, all other things being equal, because you're not paying as much on the interest of the mortgage. You're not paying as much. So you're going to have a lower monthly payment. That's the positive. Now, for sellers, it's kind of ironic, because if you locked in 3% years ago, you're less likely to sell now, which means fewer homes on the market, less inventory for buyers. If you were going to sell, you could sell for more, right? So when interest rates change, it really affects whether or not it's worth selling, or whether it's better to wait, or how much money you might be able to get for the same house, right? Generally speaking, the idea is this: rates come down, demand increases, and if supply does not equally increase, then price increases. If interest rates go up, demand decreases, and if supply doesn't decrease to match price decreases, then price, or buyer decreases, then price will have to decrease. So that's how that all works. Now, let's talk strategy. What should you do? Well, I don't know you, probably, and I don't know your situation. So that's the answer to that question. What should you do? I have no idea. But generally speaking, if you're a buyer, don't wait around to see if it might come down to 3% interest rates. You're waiting on something that you don't know will happen, and you're waiting on something that might not happen for way too long, right? So don't just wait for 3%. Buy when the price is doable, the monthly payment is doable, and the house is what you want. That's when you buy. I've talked about how do you know you're ready to buy. That's in a previous episode. You can go ahead and watch that to really understand that kind of line. But generally speaking, if the price is comfortable, the monthly payment is doable, and the house is something you like, you want to buy now, because next year that same exact house is going to be worth more, and the price is going to be higher if interest rates go down. So don't wait for interest rates to come down to 3%, because if you lock your house in now and you live there and you're owning that house and you're paying it down and you're gaining equity, and then eventually rates come down to 3%, that's when you refinance and you get that 3%. So that's what you should do if you're a buyer. If you're someone who owns the property and you're looking to reinvest or refinance, run the math with a pro. Like I said, talk to a local lender, somebody who knows how to find like your break-even point and whether or not it's right to refinance right now, or just because rates are lower, is it the right time to refinance, or does it make financial sense? Right? Because a refinance, there's a couple of different ways to do it, but like a cash out refinance, for example, would be, okay, I've got $200,000 worth of equity in my property. I'm at a 7% interest rate, or an 8% interest rate, right? But I know I have $200,000 of equity in my property. Well, you can refinance at its current appraisal value, cash out not a full 200,000, but maybe 150,000 of that, and then have a potentially lower monthly payment because your interest rate is now 2 points lower. So, obviously the math all depends on your numbers. I don't know your numbers. I don't know what your house is worth. That's why you want to talk to a lender. And then if you're an investor, by the way, watch the inventory, watch the long-term trends. Don't worry about the daily rate headlines. And the truth of it is that if you're trying to invest in a rental property, interest rates on your mortgage aren't really that huge of a deal, because like you want to buy a rental property, right? You are going to be charging market rent, I hope, for that rental property. You're going to be charging your tenant market rent. Your mortgage payment with taxes, insurance, interest, all of that should be well below what you're charging for market rent. Market rent should be way more than what a mortgage is, especially on a rental property. So that's kind of the math. So your interest rate, whether it's 5.9% or 8%, should really not factor in so much. And if it does, you are talking about buying a house that's too expensive to rent for the market rent. You got to buy it for a little bit cheaper. That's kind of where you're at there. And then if you're a seller, just hope that, other people don't bring their house to market, because the less competition you have to sell, like the less competition you have, the less properties that are selling, that are on the market, and the more buyers, that's better for you. You have, think about it this way. If you're the only pizza shop in town and the population in town keeps growing, you're going to sell a lot more pizzas, right? So let's wrap it up here. I didn't want to take a very long time on this episode. What did we learn today on the Realty Check? Well, rates aren't at 3%, and they probably they probably won't be for a while. They were 5-6 years ago. Now they're not. But they are at multi-year lows. In fact, a 3.5-year low, they're below 6%. So that's pretty good. Generally speaking, over the last 30, 40 years, you're looking at below average interest rates right now, which is really great. That shift helps buyers because money becomes cheaper. It helps refinancers because money becomes cheaper. And it helps sellers because supply is staying low. Now, I can say that, and let's say 1,000 people trying to sell their house in my area decide they're going to list their property with me because I just said that supply is low and sellers are going to be making more money. Well, that's going to be a problem, because now supply won't be low anymore, and they're going to have more competition, and it's going to match the amount of demand from all the buyers. And so then it's not necessarily going to work out to be what it is. But I can't imagine, and I would love it, but I can't imagine 1,000 people thinking about selling their house after listening to me talk about mortgage rates. But that's pretty much it. I'm going to drop it here. I am working on a couple of interview episodes coming up in the next couple of weeks here, or months, or month or so. I want to get an interview with an inspector. I had one lined up, but kind of fell through. I want to get a mortgage lender in here, especially to kind of answer some questions about mortgage rates, as well as, just generally what the process is like, what lenders are looking for. And then I also want to get, I was talking with a financial advisor. That would be a pretty interesting person to come on. Generally speaking, talk about money that isn't necessarily about real estate money, but how it connects and how it doesn't. And then a few other people, real estate investors, some contractors, that kind of thing, plumbers. So we're going to be working on that in the next month or so. I hope to see you guys soon. Make sure you follow, like, subscribe, all that good stuff. Make sure you find me on Facebook, Nick Melillo, Realtor. Make sure you follow on Instagram, or Instagram, nick.melillo. We're on Spotify, we are on YouTube, and we are on Apple Podcasts. Hey, this is Nick Melillo, your favorite realtor in Delaware, Pennsylvania, and New Jersey, as well as some people call me Nicky Bags. I'm the host and main operator of Brainwave Entertainment. We are a trivia, karaoke, live DJ, live music, and event hosting company right here based out of Wilmington, Delaware. And we do trivia and karaoke, and we have a lot of fun at different bars and restaurants around the area. We also do private events. So if you maybe run a restaurant, or you know somebody, or you work in a place that needs some live entertainment, reach out. Let me know. I'm happy to set up a time we could chat about trivia, karaoke, and all the other things that we offer. And if your school, company, organization are organizing a fundraiser or a team building exercise or some kind of event that needs a live host or a game show host or something like that, I am available for those types of events as well. So reach out. Contact information is in the description for Brainwave Entertainment. And otherwise, let's get back to the show.